Let's get right to it. Continuation of the momentum unwind. I'll give an update on that. Uh, Mag 7 correction. It's been leading us lower. So I'll kind of go through what we hit, historical context, and was that enough? I'm going to go through a sentiment collapse. Sentiment is always a hard thing to measure. I show you guys, a few things, but I think it's pretty clear that trader sentiment has come down significantly. Also, economic sentiment, which I'll get into later. Despite all of that, I'm going to go through how the breadth in the market and the rest of the world just are not part of this. So this absolutely seems like a momentum unwind at this point. Nvidia earnings came out and everyone was waiting on it. There was a sell the news type event, and then it bounced back on Friday. I'm going to go through the Nvidia earnings and just highlight some stuff, but also highlight how important the stock has been and why I think we are at a regime shift, but I also think Nvidia very likely has bottomed here just based on the pattern. And if we do get another low, I think that's going to be what's going to have to happen to really get the market to extend what's happened, which is possible. But I'll go through that, the economy, and then Bitcoin on the back of it. So let's just jump right into it. So I highlighted this last week. I just want to make sure there's a couple things. So the momentum, this was through last week. We had a bad Monday, and then we kind of back and filled in here. So it was 2 weekdays in a row. That took us to the lowest level since before the election. More importantly, momentum has been kind of dying in here, and it was dying really from February into July. So, except for this one period leading into the election where you had this massive move, you've kind of worked it off, in my opinion. So, I think that was the end of the momentum unwind. And the reason is because of how dramatic some of these names were, and I'll go through it. I did write a paper on it this week, just in a lot of detail about the momentum, the history of it, why it's an important macro factor to watch. If we had, I thought we were going to go into a recession, I think we'd have a lot more room in the momentum unwind. But since I don't, and I'll go through why, I think this was really more just a position unwind in things that had worked for really since ChatGPT, and that's what this was. So in terms of the Mag 7, this was the monthly move, one of the worst moves in the last 8 years. And since ChatGPT came out, which was right in here, we had 1 week move here in the beginning of January. But since then, we really hadn't had any weakness, and you had all of these plus sides. So since ChatGPT came out in here, just count up the amount of Mag 7 plus 10% or even plus 8%, and then this was the first one here. So I think they're still seeing earnings grow. Yes, I think, as I've talked about, I think they're going to start to underperform where they would have been, and I think they're not going to be the leaders of the market this year, but they are still growing earnings, and they are reasonably priced for the earning growth that they're seeing. So you're going to have to see some kind of collapse, and the tariffs are not going to impact them. There's just, when you're trying to get AI is just too powerful of a story, as I've talked about, and I don't think people know how to put it into the context of history. This is just the drawdown for the Mag 7. So we had a 15% drawdown. We did more, believe it or not, during the yen unwind, but the difference is this time there's nothing else moving right now. And also, the Mag 7 has been consolidating really since that time. There just hasn't been this explosive move. And so what you've had is, this is the Mag 7 relative to the S&P. And like I said, most of the move they had was a breakup into the election, or just after the election, and they gave it all up. And so now the Mag 7 relative to the S&P, it's not just unchanged since June, July. Really, this hasn't been a massive outperformance the way you would have thought since June of 23. So I think it corrected back to the 200-day moving average. I think it did what it needed to do, at least for now. Relative to the S&P, this correction was 10%. So the only one that was greater was in the 22 period, during when rates were being taken higher, and their earnings actually did turn negative. Unless we're going to get earnings to turn negative, I think an underperformance of 10% for companies that are still seeing their earnings grow double digits, I think it's just really hard for it to extend much further without there being an economic fallout. And that's really the critical thing you're going to hear from me now. The S&P can absolutely have a correction that goes down because it hasn't gone down that much. But for the Mag 7 to go down a lot more from here, there's going to have to be a build-in of some sort of a recession. And that could happen with the tariffs. It could happen with what's going on with Doge and spending. You've got Steve Cohen out there. A lot of people are starting to turn negative. But again, I think AI on the other side, tax cuts on the other side, and a belief that he can't afford to have the stock market go down. Doesn't mean it won't. The technical picture on some of these things are bad, so we'll see what happens. But I just don't think it's going to happen, and we'll go through this week by week and looking. But for the time being, I think we've done enough. Mag 7 relative to the rest of the world is an even bigger story. I mean, this was the third or fourth biggest drawdown, which again, this is when their earnings were negative. So there's no negative earnings now, and you've had a sharp correction versus the rest of the world. Everyone was long Mag 7 in a variety of different ways. Everyone was underweight China, underweight Europe, underweight emerging markets, underweight everything. Well, we've seen that play out now and have a correction. I created a speculative name basket. This has got some of the things that I very seldom show here: quantum stocks, space stocks, some crypto stocks, a whole bunch of just, I would say, momentum names that have done extremely well since the Fed rate cut. You had this big move. They gave back 62%. They went through the or down to the election level in terms of the gap after. I still think, in quantum stocks and a lot of that, that's a top for now. I think there was a lot of hype in that stuff, robotics names, things like that. I think at this point, until they grow earnings, those names which didn't have earnings, they were all based on momentum. And I think we've crashed the traders, where it's going to take the speculators a little bit of time to come back in. In terms of Bitcoin, I just want to highlight, I did in the paper I wrote, but Bitcoin is the ultimate momentum. The reason I like it more than stocks in the momentum is because whatever the momentum is in terms of beta going higher, Bitcoin tends to be with it. As long as the market's going higher, Bitcoin is the risk asset. As I've said, I think we're in the final stages of the Mag 7 as the leaders, which means Bitcoin will be the only asset of large size, in my opinion, possibly outside of gold, that drives returns this year. I still think it'll be up significantly this year on the back of stablecoins and on the back of the government, but it needed to flush out with momentum. So if momentum now stabilizes, for the people who care about Bitcoin, I'll go through at the end why there's already signs that that may have been it. Solana basically did a 50% correction, and that's on a close-to-close basis. If you do intraday, there was a day where it spiked up towards 300. It had traded a bunch of times above this level. It would have been a 62% retracement. But the main reason what I'm showing, we've done a correction even in the, let's say, the second tier of crypto names. The third tier really got destroyed. And then when you get into the meme coins, even worse. This is the thing that was surprising, and I think people have tried to find ways to ignore it. There's no way to ignore this. Sentiment has come down. I could feel it. Other people I talked to were getting called by people saying, what's going on? But those are people that traffic in the momentum-based names, that have been trying to make money on those, whether they're day traders, whatever the case is. The sentiment for traders for the AIII, the bear level jumped to the peaks of 22. I mean, there's just no other way around it, including the worst of the 08-09 period. So we did get a jump in bearishness, and it matches up with the conference board. So if you remember, I showed at the beginning of the year the conference board stock percent of people that think stocks would increase this year, and it was at the highest level in history. And this goes back a long way. Well, it just dropped 7 points, which is the largest monthly drop since the worst of COVID when we shut everything down. So anyone who's saying sentiment isn't negative at this point, they're not paying attention. We had a big drop off in sentiment. It doesn't mean it can't sit down here. I just want to highlight the bull sentiment collapsed, but we stayed down here in 22 for a long time, and this is year over year S&P. And this is basically what I highlighted at the beginning of the year was when you have sentiment kind of sitting up here, which is where that conference board was, year over year S&P needs to kind of slow down and go down. And that's the kind of year I thought we'd have. I didn't think we'd have the 25% year. I thought it would be much more choppy with Trump as president, particularly with the policies trying to get through. And I think that's exactly what we're seeing. We don't know the extent of the tariffs that are going to happen, but we do know that you can't be playing with risk at the levels that you had. I'm going to start showing this more and more because it tends to match up with what we saw in AAII, which is this is the crypto fear greed index. I showed it before. It collapsed to lower than it was on any reading, especially over the summertime. So we really gutted a lot there. And then there's another one where you can see that we came all the way back down again to the 22 levels in terms of the fear greed index. So crypto was wiped out on the momentum side, and then this is that chart I was saying of the historical highs going into the year of the percentage of people expecting 12-month increase in stocks. It came down sharply. Year-over-year S&P is coming down. I still think year-over-year S&P is going to head towards single digits, if not towards zero, during the course of this year, which means we're going to have a period of time where you're going to have choppiness. You're just not going to go up in a straight line. That being said, here's the reality of the situation. Everyone got that bearish. The S&P was down 1.4% for the month, so not a big deal. And it's still up for the year, and it's had plenty of up months. So you got a down month, nothing big at the end. And if you look at the world index, which also includes the US, it was down 74 basis points. And again, look how many up months there's been. And then you get this one little downtick in there. So the rest of the world was much stronger. And this is the year-to-date performance. S&P's up 1.2%. Just look at all these that are up. I'd be more worried about the healthcare, staples, real estate, utilities being strong. I'll get into why I'm not worried about it right now and what you should be watching on that front. But you can see these are the names that have been dominating performance. You've got the three, this is where the Mag 7 live. This is them in commercial services, infotech, and consumer discretionary. So it just looks to me like people were bailing out of things that had worked really well the last 2 years. Just to highlight that this was not a complete AI tech unwind. The boring names in tech, or the used to be boring names, IBM sitting at all-time highs, barely budged last week. Cisco, one of the biggest benefactors from the data center build out. Cyber, no correction whatsoever, still sitting up near the highs. It's taken all these years to get back up to where it was at the peak in the dot-com bubble, but that's where that is. Very, very indicative of people are just not in there. And then without anyone talking about it, this is the S&P breadth. Cumulative breadth is basically at the all-time highs. We're slightly off the highs, and we literally went up into March. We went up at really high levels. So you've had a big move higher in this in terms of breadth, just not showing anything. MSCI World X the US, the white line here, we had based in there for almost all of 24. We bumped higher. The S&P looks like it's in a consolidation. Like I said, I think it's possible this could turn into something bigger. It would have to be economic related. But as of right now, the rest of the world is doing fine. And here's the S&P. You've posted back-to-back 20% years. We've had a correction. Sentiment has collapsed, and we're still up 1.5%. And I've got people telling me it's going to fall 15 on the back of Trump's policies. So sentiment has just come off very sharply, and I think it's important to keep it into context that the market is kind of taking all this news again, and it's saying, if anything happens to the surprise side in a positive way, if the tariffs are delayed another month, I think you're going to get another new all-time high, and maybe we fail again and we go through this thing the entire year. But I think we're starting to get to the point where the momentum stuff is unwound, and I think you can safely look for names that are growing earnings. And as long as you have the backdrop of strong earnings and no recession, you're still going to have a year where risk assets are going to be up as people get more negative on the economy. In terms of the drawdown in the S&P, you can barely see it. So off the highs, we barely fell, including the one day it was down. I just want to highlight the Mag 7 with all of that weakness and everything else. It was up over 100% in 23. It was up over 60% last year. And year to date, it's down 6.5%. So for all that, you've had barely any correction. With Bitcoin, it's the same thing. The amount of people that have panicked and called up saying, what's going on? Bitcoin was up over 150% this year. It was up over 100% last year. It's down 9% year to date. I'll go through some charts that just highlight the importance of some things related to Bitcoin and how it's part of this. But just again, Nvidia versus the momentum factor. I just want to show Nvidia has been momentum. It's been the driving factor because at the end of the day, Nvidia is as long as the CapEx is coming through, the AI advancements are happening. The AI agents are happening. The profit margin growth is happening. So as long as Nvidia can burn off the excesses, which in my opinion, if you look at the stock, I mean, we were up at 140 back in June. We're still here. So we've burned off a lot. And so if Nvidia has made a low, and I'll go through some things at least to think about on Nvidia, that's where it's going to become important. If Nvidia breaks down below the lows that it made here, like 116, and we start to trade lower, then I think you're probably going to have another leg in the momentum stuff. But just in terms of the argument for Nvidia, so they went through earnings, and this is the price target by the analysts out there. What you see is that Nvidia has had plenty of times where it's fallen off from the price target, and then eventually it just grows itself back into the price target. The price targets have never been egregious relative to the stock price, and it's worked its way higher. So now we've got a 175 average price target right now, and we're down at 125. So in terms of like what we've done, we've really found a way to burn this whole thing off while the earnings continue to grow and the analysts keep saying we expect more to come. It's driven the PE down to levels that haven't been seen, the lowest level outside of kind of pukes in the market since 2016. So you're sitting at levels where you have some cushion fundamentally. For those of you who don't follow and you just figure, you're reading stuff like it's peaked, it's done whatever. This is the data center growth, including the fourth quarter. So this comes in at 35 billion. Here's where it was last year at this time at 18 billion. So we're still talking at 93% year over year and 18% quarter over quarter. So you can sit there and say it's overvalued at whatever I just showed, 23 times earnings, but I mean, it's not egregious. In terms of people panicking about the profit margins, just look at what happened. They took their profit margins up to here, and we've had a slight incremental downtick as they do a big build out for Blackwell, primarily due to the production ramp up of Blackwell processors. So there's this whole debate on everything, and it's just ridiculous to me to just look at it and not at least be like, okay, we had a 26.5% correction in it. It was a big fall. Like it went down a lot. So when you go down 27% after DeepSeek, and then you kind of spend some time and you have this big reversal after the negative earnings day, we'll see how everything trades, but I think you want to pay attention to it. I bring this up for everyone who's saying Bitcoin has had a collapse or whatever. Nvidia falls 27%. No one seems to really care that much, and they go, Bitcoin had the exact same percentage fall. So I view Bitcoin as being the dominant asset again this year as the year plays out because of the deregulation that's happening, because of the sponsorship there, but also because of the adoption. I'll go through some of that in terms of the changes because BlackRock added it to their model portfolio. And I think you're going to see more and more places do this. I also think you're going to see higher numbers of what we saw. But this is really the big story for you guys. The profit margin. And again, I'm going to keep harping on this because you want to see if it's spreading out. And the blended net profit margin for the S&P is 12.6%, which is above the previous quarters of 12.2, above the year ago 11.5, and above the 5-year average 11.6. At sector, 9 sectors reported year-over-year increase in their profit margins, led by financials. And this is a critical part in this because this is one of the sectors that I think benefits the most from AI. The main point is here, you just have very big profit margin stories from AI as the adoption grows. This shows you the sentiment. We had larger cuts than normal for Q1. Given the concerns in the market about inflation and tariffs, they've lowered their estimates. So this is the first place you're seeing, again, people, they don't know how to deal with the tariffs, and I get it. If he puts large tariffs in, it's going to have an impact on the economy. It's going to take inflation higher, and you're going to see businesses not know what to do. They're going to slow stuff down. It'll have a slowing of the economy. When Steve Cohen said he thinks the economy could slow from 2.5 to 1.5, and I heard people say it's a big deal. It's not a big deal. That's not a recession. That means there's no real big job losses, and that means rates are going to go down, which is what's been happening, and it gives the room for the Fed to cut, except for the fact that we've got the tariff side. So we're kind of in this place where you can see where there's a cap on the market as we go through this attempt to get the budget in better order, and the fact that he's trying to do it before the midterms next year. So I do think it's going to be a choppy year because of that. So Americans are expecting higher inflations. That can unnerve the Fed. Again, more and more people are talking about the inflation side. It showed up in a huge way in the data. This is the Conference Board. Inflation expectations for 1 year up 80 basis points. The biggest monthly increase since back in 22 and after they printed money. I mean, as I've said, I don't know how Donald Trump can do anything to raise inflations without taking a severe hit in the polls. Inflation is what has taken down governments around the globe. You can do whatever you want in terms of the budget deficit. For people who are voting, it's not a high margin. And if you mess around with prices at a time when prices are already a little bit of a problem, it will have approval rating side, and I just don't think that that's the way they're going to end up going. And then if you move the stock side lower, then the revenue side comes in. So again, fiscal dominance in the position the government's in it's a very difficult predicament. I don't structurally think that they can change everything. I think the fraud and stuff from Doge and all the things they're finding, I think that's great because that's not really money multiplier. Government's not a great investment side. But if they can save a couple $100 million to $500 million, great. I mean, we just increased the CapEx numbers for AI over about 70 to 80 billion for this year. So I'm not really concerned about a recession, but I do think the regime of, again, stagflation, I talked about it last week and said that's the regime we're in. Well, you got Mohammed Al-Arian now writing about it. Everyone's kind of talking about the inflation side. And, you know, Trump had to acknowledge it in a press conference this week. And they're trying to boost egg imports, which sounds funny as it is. But regardless, he acknowledged the fact that it's a disaster right now. On Friday, we had a huge drop, which got a lot of press in the GDP now, where first quarter GDP now dropped from 2 and change down to 1.5. Some of that was because of the inflation numbers relative. Once we got the spending numbers, inflation was higher than spending, so you had a drop off to some degree because of that. We'll see how the inflation numbers are the rest of the quarter. But the biggest problem was on the trade import side. This is the sentiment side for the consumer confidence, which dropped significantly. So you had the largest drop since 2021 in a month. So confidence dropped. And then this is the chart I was referencing. This is the trade side. So this is the thing that took GDP now. The reason this is important is this will snap back. This seems to be a massive front loading of imports before the tariffs went into place, which would make sense. So by having this massive drop off, you should see a bounce back up here, which means we'll get back in a positive territory for that. And then if the inflation headline number doesn't continue at the season, you know, the worry that we had in January with the seasonal adjustments, you'll get a spending boost back up too. So we're not talking about a negative GDP. We're just talking about a situation where it's come down. In terms of people are watching the claims now, again, applications unemployment for federal workers program. So this is going around. People are worried about claims. I'm not worried about the job situation at all. You're starting that recession. U.S. recession no longer seems completely unthinkable as jobless claims spike higher. So I think the media is trying to talk up this. I think that's going to be going on. But the reality is we are seeing weakness in the data. Now, again, this is a sentiment thing. So this is the City Surprise Index. This means that are the data releases beating or missing the economist forecasts? So we're missing. The white line here is going straight down. I think people got over their skis on the Trump policies. The peak happened right after he took in. Everyone was expecting there to be a growth surge in inflation. And what we've had is the data has been missing and it's been going down on a weaker side. And this is with the jobs number being okay. So I think this has been important because what it's done is it's taken 10-year rates down. So 10-year rates have followed, as they normally do, the City Surprise Index. And so when people were expecting us to head up to 5% and we got above 480, well, now we're down to 420. There's a 60 basis point cut. and we're back to where we were before he took over. So you're going to start to see some improvement on the housing data because it's come down, and the other places where rates are. And he has a goal to try and get rates down. So I just would watch that, because I think we're just in this phase where we had a stronger dollar, we had higher rates. Now we've had a weaker dollar from the peak, and we've had rates come down. So we'll see what goes on with the tariffs. But I think we're just kind of jostling around while earnings growth and AI are structural. And that's the key thing to do. And here's the other structural side. Rates have come down, economic fears have gone up, stocks were in a correction, and credit spreads have not budged. If there's any weakness in the economy, trust me, credit spreads sitting at all-time tights will show it. The leveraged loan market has not moved at all. It continues to print. This is total return for the leveraged loan ETF, and it has not budged. We have absolutely nothing going on. This is a quarter. These are quarterly numbers. Everything is good, guys. There's nothing going on inside the credit markets at all, and banks aren't either. If there's a problem in the economy, banks are not going to be outperforming the S&P, and we've been in an uptrend in this. This spiked and has been spiked after Trump. It came down, and then it's gone right back up on a relative basis. You're going to see weakness in banks at some point, and this is one of the things, and this is the reason why the S&P matters. If the S&P is not going down, last year, household net worth went up by over $10 trillion. I've said this before. When we talk about saving $300 billion or $400 billion, and then people come out and say that's going to take the economy into a recession, it's about spending, and it's about CapEx. CapEx is there. It's going to happen. These companies are not affected by the tariffs, and they're racing for AI. And then the other part that matters is the top 50% of spenders, and if you want to expend it higher, this is the share of spending by the income groups. So if you fire people that are in the lower income side, they just don't drive the economy anymore. This number has been moving this way for a while, but when you take the top 10, and then you go to the next 10, I mean, you're dealing with 20% of the economy is driven, or 60% of spending is driven by 20% of the people. So there's just a math side to this. So people that call for recessions or call for anything, they're just making stuff up. They're really just using history and saying, well, this is going to collapse us. If stocks fall, then those groups will stop spending the way they have, because stocks are what's driving household net worth. So you want to see stocks go down as long as breadth is fine, and as long as the only names that are going down are on the top end and they stabilize and sentiment goes down, then everything is fine. So we'll keep watching it, but you're going to need to see spreads widen out. You're going to need to see the banks start to underperform, and you're going to need to see the stock market go down for there to be any fears. And if these falls happen in a sideways market where half the stocks are going up, or more stocks are going up than going down, that's indicative of no recession, not indicative of a recession. So I'm just going to keep saying it. And again, the top 10% own 87% of stocks. So that's what drives the economy at this point, is the stock market, and right now it's fine. Just CEOs signal the highest confident, and you can't see it here at this point, but it's 2 years. So again, CEOs are confident. That's where we are. It was a big week for AI because we've done so much on the market side. I'm not going to go through everything. OpenAI is 4.5. I'm trying to think if there's anything in here that's worth going. The Amazon AI Assistant, Alexa, and then Claude put out their next one. Nothing big that you guys need to worry about. But I thought this was really interesting, and this is something that to me is about why the Mag 7 to me are going to have trouble, not with earnings. They're not going to collapse, but I think their growth rate will be slowing every year. I think they've seen the peak of their benefits from AI. That's just my own opinion. I don't see how they're going to get the return on investment at a level. It's not bearish. It's just their multiples are probably going to compress like Nvidia's did, where if they don't meet good numbers as a group, it's just going to be hard, and I think they're going to be hard to move. So I think we're going to be in multiple compression for those names, while we see the increase in things like IBM and Cisco, which are trading at half the PE. So a Cisco is still trading, I think, at around 16 PE. They should be a market multiple. They're benefiting from AI in multiple ways. IBM, the same thing. They should be market multiple stocks. They shouldn't be trading below where the Mag 7 are at this point, and I think that's what you're going through. The reason this is important is Stripe is showing the time it takes for startups to get to revenue milestones, annualized revenue milestone. It's happening at much faster pace than in 2018. And I don't think these companies, because of competition, are going to be able to IPO at big numbers. I think this is going to be a massive growth in the entrepreneurial side, which will take away from the public markets. I just don't think these companies are going to be able to go public. That's, again, I think from what I've heard out of Silicon Valley, and the phrase that I've heard, instead of there being three $100 billion companies, there's going to be 300 billion dollar or sub-billion dollar companies. And if that's the case, those companies may never go public. And if they don't have a monetizing event, and they don't need a lot of equity to grow, then you're going to have a change in who's driving the economy. And I think entrepreneurs that are getting laid off by Meta and other places are going to do that. Bitcoin, just quickly here to highlight why I think that was it. So we had a month. It was down 18% for the month by the time it closed. Again, massive months the prior year. Should be no surprise that we're getting a correction in Bitcoin. I thought we were trading well enough up there and it wouldn't take much to break out, but once we got another leg lower in momentum, not a surprise that it couldn't hang in there. And then once it broke down, one thing people that trade Bitcoin are going to have to get used to, it's going to be used as a hedge against tech. It's going to be used in the TradFi markets. I would say more as a beta hedge, whether it's to the upside or downside. And the short base has grown in Bitcoin. I've heard multiple different macro funds say that they thought it was going back down to the Trump breakout area. We got pretty close to it. And then on Friday, we ripped higher after BlackRock announcement. So the drawdown, normal drawdown for them, I mean, 20%, aside from the 18-19 and the 22 period. I don't think this exists anymore. This was not only FTX, which obviously can happen at any point with a growing technology, but I think we're in a world where the vols come down and these types of corrections are going to be the norm going forward. It trades at about a 50 to 100% vol premium to the Mag 7. So if the Mag 7 has 20% corrections, you'd expect this to have 30 to 40. The fact that we had a 15% correction, this is about exactly where in my mind it should have been. So I think Bitcoin did exactly what it should. And again, just to highlight, 100%, 150, and then down 10. This is not a big deal for Bitcoin. In terms of the charts and just some reasons why I think the lows are in. So this is my side on it. This is the 1 year average. So it's kind of like a 252 day, but this has worked really well over history. Also, this was the peak before we broke out, before the election. So I kind of use this. Intraday, we got down to 77. Looks to me with that kind of reversal, that might be it. We'll kind of play out. But the other thing was just using some candlesticks. And again, I spend a lot of time watching this stuff trade because I think it's important and I think it's an asset that will continue to be a growing trading asset. You got some nice RSI divergences at the lowest level going back to here. And if you look at these prior ones where we had divergences where price made lower, you get divergences in the RSI. This is a 4-hour RSI. It looks to me like we've held in there. And then to finish up, if you didn't see it, there's going to be a crypto summit. The only reason I bring this up is you have to remember that the administration absolutely needs crypto. They were huge in deciding the election, a massive part. I don't think he can allow to not be positive on this and continue to move things forward. So that's it for this week. It was a busy couple weeks, but I think we've kind of found some stabilization. We'll see how the tariffs go this week and how the market responds to it. But watch Nvidia and see how it trades here in this 115 to 125 area and see if it can build the bottom. That's it.